Hello, I'm John Janarone, Editor-in-Chief of CorpGov. Very happy to be back in New York at the New York Stock Exchange. Today we have a great guest. In fact, I would say a rare occasion to speak to someone with a background from BlackRock. We have Jessica McDougall, who is now chair at Longacre Square, where she's a partner of the Shareholder Engagement Practice and Corporate Governance. Jessica, thanks for joining us today.
Absolutely, thank you for having me.
So Jessica, as I just mentioned, it's really unusual to talk to someone from BlackRock, particularly from the group where you used to work. We'll get to your new role momentarily, but tell us a bit about the role that you had at BlackRock.
Sure, so previously at BlackRock, I was responsible for overseeing the proxy voting and engagement for companies within the industrials and materials sector. And the investment stewardship team broadly at BlackRock is the largest in the world. It's approximately 70 individuals across the globe. But each of those voting analysts is responsible for the engagement and voting for the companies in their sectors, which is a really unique model as it comes to stewardship teams compared to other institutional investors.
And for our viewers who aren't familiar, can you remind everyone why BlackRock is so important? In many cases, BlackRock and a couple of other major institutions own a big chunk of many public companies, right?
That's correct, yes. Usually a top 3 shareholder in most publicly traded companies.
Right, so that means you guys really mattered when it comes to voting.
You could put it that way.
So tell us a bit about some of the action we saw with when things got political. How did that look from inside BlackRock when you had some of these Republican states saying, we don't like all this ESG business?
Sure, so I think it's important to take a look back at where we've been with ESG, and this topic certainly began to accelerate within the stewardship conversations and within the public reporting for companies that BlackRock and other institutional investors owned over the last 5 years or so. And I think the term has become a lightning rod for many institutions, many individuals, but really it's important to get down to the core of what this was originally seeking, which is looking at material sustainability related best practices, which often for many companies across different sectors relates to operational efficiencies, best practices, and a longer term value creation opportunity for their shareholders. And so that's really what ESG is about, operational efficiencies, making sure that when companies perhaps have a large carbon footprint, they're considering how a future environment with a carbon tax or accelerated climate change could impact their business model, or even those that are heavily reliant on water, what that means from the perspective of should that not be as available and how they will be able to continue to make their products. So that the shift in politicization of ESG, I think, has come with a shift in understanding of what that ultimate goal was. And so, there are many reasons why different people go after certain things, but I think it's important to come back to the core of what was really meant by institutional investors, particularly those that had a long-term outlook, such as BlackRock.
Now, let's talk about the E in ESG for a moment. In the green room, I was asking you out of curiosity, how do these chemical and pesticide companies look at this? And you surprised me because you said, in fact, these aren't just villains. They actually thought about taking care of the environment, not being that pollutive, and that's because their customers cared, right?
Yes, so this is an example of how ESG, when integrated well within an operating model, makes complete business sense for a company. For example, chemical and pesticide companies, where they're able to better engage with, for example, their farmer customers and how to best apply the pesticides. Not only are they helping to educate their core client base, but that helps them have a stickier client when that farmer can go to the company as a resource for how to better grow their crops. But it also leads to less runoff in local water streams and ultimately less liability for a company should that come forward, if there was an issue with the water supply and how it's impacting stakeholders.
Now, let me ask you something. This came up at our annual conference down in Palm Beach at our Palm Beach CorpGov Forum a few weeks ago where a number of your colleagues were speaking.
Yes.
Someone put a question to a panel, was ESG something of a fad? Tell me how you would respond to that question.
I don't think it was something of a fad because I think those companies that are considering what's most material within a wide spectrum of ESG topics are really positioning themselves to be best-in-class operators. And I think, again, this term has meant many things over a period of a decade or so, sometimes veering into the realm of impact investing or, faith-based investing historically. But really the core is to understand how companies are thinking across a range of material impacts, opportunities, risks, and dependencies to their business and how they are effectively mitigating those or capitalizing on them.
Great. Now let's pivot and talk about your new role, of course. Enough
Yes.
about BlackRock for the moment. Longacre Square, which is a strategic advisory and communications firm, I know a lot of your colleagues very well. It's obvious to me that your background can serve you very well talking to clients there, but it's not just companies, you're also talking to investors, right? Tell us about your role and who you're advising.
That's correct. So we advise both investors as well as companies, many of which are public, some of them are private. But really our goal is to engage in these conversations for investors or companies to understand how governance best practices might further either an investment thesis for the investor clients. Sometimes those are within the activist realm of trying to create change at a public company, or for those other corporates and public companies, how engaging with their shareholders on a regular basis can help them not only get feedback that could help improve their governance structures or the way in which they're evaluated from an institutional perspective, but also, ultimately align up structures that can lead to long-term shareholder value as well. So it really plays on both sides, but a similar topic of, good governance can help create those ends.
So tell me, if you can, a bit about a typical conversation with, say, a corporation that wants to understand how the Vanguards and BlackRocks of the world think. Are they often just unsure about how it works? I mean, as I was discussing again in the green room, this is a bit of a black box to a lot of us because folks from BlackRock don't often come out and speak as you are right now with me. So tell us a bit about how those conversations go. Are they surprised, or are there things that they need to get up to speed on about how BlackRock, T. Rowe, Vanguard, et cetera, think?
Sure. So, I can speak from my experience in working at BlackRock. I also held a similar position at TIAA over the years. But companies, they do sometimes need to better understand how it just works and function during proxy season in particular, when there's such a high volume of work. The investable universe basically has their annual meeting in a 6-month period.
Yeah.
And that's a lot of proxies to read through.
Right.
So it's really understanding what the issues are for your institutional investors that are making the vote decisions. Often that's held within the stewardship teams of these bigger asset managers. But of course, portfolio managers, particularly where there's an actively held position, have authority over a vote where those positions align with within their portfolio. So there could be a conversation between a stewardship team and an active portfolio manager about routine items such as the election of directors or executive compensation, or sometimes shareholder proposals. But it becomes particularly important where there's a contested situation where the stewardship team and or the active portfolio manager need to evaluate whose case is best presented. Is a case for change the best course of action as presented by an activist, or has the company demonstrated following through on what they've said historically and their operating model?
Gotcha. Now, without giving away too much of your secret sauce, which is what your clients are paying for, tell me this. I'm just curious. I've seen companies create presentations for proxy advisors, ISS and Glass Lewis. Is the messaging different when you're talking to an institution like BlackRock, from both the company or the investor side, or is it similar?
It's a similar message. I think it also depends on how the company has engaged with their investor base historically. For example, if there hasn't been a record of year-on-year engagement, you might need to go a little bit deeper as to why the case is sound from the company's perspective. But for those that have gotten out in front of their investors on a regular basis, seeking that feedback, having year-on-year engagements, it's much easier to pick up on a topic that you've just discussed historically to show how you've made progress or considered that feedback versus starting from scratch. And that's a unique position of the BlackRock stewardship team in being market-specific and sector-specific for their analysts, whereas with an ISS presentation or for Glass Lewis, the other proxy advisor, you might need to start with a little bit of background because they might need a refresher on where the company's been and as it compares to peers in particular.
Gotcha. Now, are there some companies, and I'm thinking of smaller companies, that might have BlackRock and Vanguard, et cetera, as major shareholders, but have never really had a relationship with them? Is that the case sometimes?
It is the case sometimes, and I think it comes down to, again, the volume. We just talked about proxy season as a major high volume time, and the priorities at stake here. So if there is a smaller company that hasn't really had any urgent issues, there was nothing much to discuss, there could be a case where the stewardship team hasn't engaged with them based on a function of needing to triage priorities. I would certainly not deter smaller companies from reaching out. I think it's always good to show that you're aware of a governance best practice of engaging your institutional shareholders. But if there's nothing pressing, I wouldn't take that as necessarily a negative if they are not able to get a call.
Well, I mean, I have to guess, so tell me if I'm wrong, if I have a relationship with my big shareholders, BlackRock, Vanguard, et cetera, and an activist appears, am I in better shape if I already know these folks and I've talked to them and they know my story and what I represent? And so what I'm driving at, Jessica, is it good to be proactive and try to establish those relationships before trouble appears?
I would say so, because you're not starting from point zero. You might be starting halfway there, basically, and recapping the conversations that you've had over the years and showing how you've implemented shareholder feedback as a point of making the business stronger. Whereas, and in many cases I've seen, the activist argument relates to governance or a wide range of ESG topics that the company may have engaged with their institutional shareholders on. And it's much easier to say, we're aware of these topics, we heard your feedback and this is how we've been implementing it over the years, versus trying to play catch up, essentially.
Great. So just getting back to this politicization issue, do you see this fading away? I mean, it was all over the news over the last year or so, but it seems to be quieting down somewhat. What's your take?
It's hard to say exactly. I know many companies are waiting for forthcoming SEC-related climate disclosures and using that to guide how they'll be positioning their public-facing disclosures going forward. There are certainly frameworks that investors have pointed companies to from a disclosure perspective that they view as most useful in helping to evaluate how companies are looking at these risks and opportunities. But I think ultimately my hope is that this isn't a separate ESG bucket, but one that's just considered from a fundamental perspective for companies and looking at them from an operations perspective.
On these sustainability reports, tell me, I'm really curious, because when it's coming from someone like Exxon, I'm very curious and I flipped through it, but I feel like everybody has one now. How important are they? Are investors really reading these things? I mean, obviously with a company that has historically had environmental issues like Exxon or name your pesticide company, I get it, but there are a lot of companies that have them and I think, well, I don't really know how interesting this is going to be. I mean, tell me about that. I mean, would you recommend all companies spend a lot of time and resources on these, or maybe in some cases not as important?
Look, it certainly is a balance of time, resources, money, and where that goes to produce an external facing report. And I think for some companies, there are many actions that they've had in place for years or are tweaking to, again, enhance their operational efficiencies, cut costs for shareholders, or better mitigate risks than perhaps their peers. And I think in those cases where these elements are material to the business, it's worth pointing out. That doesn't necessarily have to be in a sustainability report. It can be in the 10K or other forms of annual reports, but it's important to know the audience for which they're speaking to, because some companies, are included in certain ESG or sustainability related indices based on a variety of rankings, and that information is scraped pretty methodically, and so you just need to put the information where it can be found if it's something that you're really doing that's contributing to your company.
Great. Now, Longacre works with a lot of activists, and again, I'm not asking you to give away any secrets here, but do you have any predictions about the upcoming proxy season? What sorts of themes might be coming up? Are we going to see ESG-driven campaigns? Tell us. Give us your crystal ball.
Sure. As we are winding down 2023, we are certainly knee-deep in what's ahead for 2024 as nomination windows are closing for directors and companies are planning out their proxies. But it was a widely publicized event where Starbucks received several director nominees that were related to human capital as a key component of their business. It's something that was operationally material to the company, and that is an example of an ESG element.
All right. Well, I think they liked your answer there, Jessica.
Yeah.
Just in time for the opening bell. All right. Well, Jessica, I think we'll leave it there on that high note. This has been Jessica McDougall, who is a partner at Longacre Square, where she's the chair of the corporate governance and shareholder engagement practice. Jessica, thanks for being here.
Thank you.